So welcome back to campus, and hope you're enjoying reunion weekend. And thanks for coming to this session. I realize it might not be as festive as other things you might be doing, but hopefully a kind of important topic. You'll find it an important topic to talk about. Start off by introducing ourselves. I'm Eiko Maruko Sunawar. I am a professor in the History Department and Asian Studies program. I've been at the college since 2003 as a member of the faculty, and I'm currently serving as provost. And the role of the provost is to make a lot of decisions together with Mike and other colleagues about resource allocation at the college. And so we're very much kind of collaborators when it comes to the financial side of the college. There are also various areas of the college that are in the kind of provost's area. So that includes the libraries, the museum, the science center, admission, financial aid, OIT, information technology, institutional research, and the Zilka Center for the Environment.
Great. Thanks, Eiko. Hi, everyone. Thanks for joining us this afternoon. I am Mike Wagner. I am the Vice President for Finance and Operations, which effectively here at Williams is a kind of a combination of the Chief Financial Officer and the Chief Operating Officer for non-academic kinds of activities that don't report to the deans or to Eiko as Provost. So I am actually a member of the class of 1986 of Amherst College, so forgive me for that, but it is what it is. I also went to Northeastern for my master's degree. I've worked at PricewaterhouseCoopers and at Dartmouth College before coming here to Williams. My role, the activities, other than the partnership that Eiko and I have around resource allocation and monitoring the college's finances, some of the areas that report to me include finance, obviously, human resources, dining services, facilities, both the planning, design, and construction, as well as the operations of facilities, campus safety, and the Children's Center. I think I got them all. But so it's a lot going on here on campus these days.
All right, so what we thought we'd talk about today are kind of these three topics. We'll start by talking about the kind of financial model of the college. And then we'll say a few words about strategic priorities, and then also touch on the college finances in the context of the current financial landscape. What we thought we'd do is hold questions until the end, if you could, so just make a note of them, and we're happy to talk about anything that you're wondering about in the Q&A. All right. So starting with kind of financial fundamentals of the college. So important to understanding the college's financial model is understanding the college's expenses and its revenues. So we'll start with the expenses, and what you'll see here are numbers for the next fiscal year. So our fiscal years are July 1st to June 30th, so the numbers that you'll see are for the next fiscal year, that's fiscal year 2026. So starting with the expenses, our largest category of expense is people. That's compensation, salaries, and benefits for faculty and staff. This isn't terribly surprising because higher education is a very people-intensive and people-centered enterprise, and I think that's especially true of the kind of Williams model of education. The next category is what we call managers' budgets. You can kind of think of this as departmental budgets, and there are many things that fall into this bucket. It includes everything from lab equipment in the sciences to food in the dining halls to the natural gas that we use to heat our campus. So that's about 20% of our expenses. Next is buildings, and buildings break down into two categories. One is capital renewal, so maintenance, upkeep, addressing deferred maintenance on our buildings. And the other is debt, and that's debt that we have issued to pay for capital projects. That's major building projects for which we issue debt. And then there's a small category of other. Then on the revenue side, our largest source of revenue is a draw from the endowment, or what's called the endowment avail. And you'll notice here that that draw from the endowment funds more than half of what we do every year. And also, as a matter of principle, we do not draw more than 5% of the value of the endowment over time. And that is in order to preserve the purchasing power, the real value of the endowment over time. The other thing that I would say is that this level of endowment reliance, this 57% that you see here, is relatively high. That is, Williams is an endowment-dependent institution, and we are more reliant on the endowment than many of our peer institutions. There are few peers that will have models that look like this, if you think about Amherst, Swarthmore, undergraduate part of Princeton, for example. But we are a very endowment-reliant institution. Also very important as a source of revenue is tuition. So what you see here is gross tuition, that's $190 million. That's what tuition revenue would be if every student were paying the full sticker price. And then we subtract out from that financial aid. So that $102 million is our investment in financial aid. It's what we spend on financial aid, what we will spend on financial aid next year. And that leaves us with net tuition revenue of about $88 million. Also very important is giving. And this giving is annual giving and current use giving. So very important at about 10% of our revenues every year. And a small amount of other. So a couple of observations if you look at our financial model. One is that there aren't all that many levers to pull when financial times are tight. The other important observation is just how important philanthropy as well as careful management of the endowment is for everything that we do. And that philanthropy you see reflected not just in the annual giving, which is very important, but also in the endowment, which consists of many, many gifts that have been given over time. So we're very reliant on philanthropy to enable what we do. All right, so we'll take a deeper dive now into the expenses pie. And what you see here is our kind of categories of expenses. So the kind of reddish is financial aid. Now, you will have noticed that in the pies that I just showed, we show financial aid in the revenues pie as a kind of contra revenue. Here we're showing it as an expense. It's not strictly an expenditure, but it is a very important resource allocation. So we're showing it here as an expense. So that's the red. The purple is compensation, yellow is managers' budgets, pink buildings. And what you'll notice here is that the fastest growing category of expenses over the last 10 years has been financial aid. So that's the 46% in real growth that is above and beyond inflation in the last 10 years. The second largest category, the second fastest growing category is compensation for faculty and staff. All right, so you may sometimes have the question or get the question of kind of why does Williams cost so much? So this is our attempt to kind of speak to that question. We were not going to go through all of these bullet points, but I'll say a little bit about the left-hand side of this slide. Mike will speak to the right-hand side. But I think really important here is just how unique a Williams education is. And part of that has to do with the fact that our faculty members are not just excellent teachers, but they are also active researchers, scholars, and creative artists. And what that means is that the college financially supports both those enterprises of teaching and research. And so that is a resource-intensive enterprise. That alongside the low student-faculty ratio that helps really make a Williams education what it is. We also have a very robust co-curriculum, including things like lots of summer experiences, winter study. Also, the fact that this is a residential experience. As it turns out, it is quite costly to house and feed more than 2,000 undergraduates. Access and affordability has also been a commitment, an important commitment for quite some time. I'll say a little bit more about this shortly, but that also includes our all-grant financial aid program, which I'm sure you've heard about, but this is no loans and financial aid packages, no summer earnings expectation, and no campus work requirement.
So I'll cover the right side, and the top box gets at really the scale of Williams. And these are challenges that all small colleges and all small colleges in rural environments face, right? That we're a small college, so the expenses we incur are spread over a smaller base of students than if we had a higher enrollment. So that's one fundamental issue that drives costs. The next three bullets touch on some geographic challenges that we have. We don't have a lot of healthcare opportunities. We don't have a lot of mental health care opportunities in this area. We have trouble outsourcing things. We have trouble bringing contractors into this area, and that can often lead to increased costs as well in the variety of activities that are going on. And then the last bullet on that top box is touching on our role in the community, which is incredibly important, right? The college with our students and our faculty and staff are a really, really important part of the community, both directly through contributions we make to the town, such as the fire station that you may have seen driving in that the college was an important contributor to, but then indirectly through that community that all of us are a part of. So it's a really important part of that. The lower box is touching on the facilities, and just a couple of metrics. You know, the college on campus, we have over 125 buildings, more than 3 million square feet of buildings, over 450 acres of campus, and all of those things add up to Williams being one of the least dense campuses on a per student basis in the country. So that size of the campus is a wonderful place to experience for faculty, staff, and students, but it also can drive costs because of the size of that. We also have a commitment to sustainability that adds costs to certain of the projects, and some of the projects that are going on now where we've made commitments to sustainability that will increase the cost if you were to put that building in another campus that wasn't as focused on sustainability. And deferred maintenance, which is a challenge for virtually every college and university in America. But for Williams, we've estimated it being over $250 million of backlog of deferred maintenance that we are trying to chip away at, both through budget allocations from the operating budget and some of the future planning for major capital projects to try to catch up on some of that deferred maintenance. So I'm going to pivot now to revenues, and just like that other slide that Aiko touched on, this is all of the revenue sources over time, net of inflation. And a couple of the key takeaways here are that the current use gifts, which I'll dive a little deeper into on the next slide, relatively flat on an after inflation basis over this 10-year period. Tuition, gross of financial aid, a little bit of growth, 1.2% growth, gross of financial aid. We'll talk about net of financial aid in a minute. And some of that is due to the rate increases as well as a modest amount of enrollment growth over the period. The important takeaway is this, what we're calling asset use, which is that draw from the endowment, which is the fastest growing funding source of the college's expenses. If you went back to that pie chart that Aiko showed earlier, the endowment would have been, in 2014, would have been funding about 48% of the college's expenditures. And now it's 54% here in fiscal 24, and in the budget that Aiko showed, it's actually as high as 57%. So that is a wonderful thing for Williams to have, but it does present risks when you think of how much of the funding is coming from that endowment. A little deeper dive, Aiko mentioned the 8 to 10% of the budget being funded by current use gifts, which are both the alumni fund and all other current use gifts, many of which are restricted to certain programs. Those have been flat to slightly negative over the last 5 and 10 year period, just as it has been in many colleges. Many of our peers are experiencing the same thing. The two other flavors of gifts, Aiko mentioned one, which is endowment giving, which we have trended and expect between $20 and $25 million a year in endowment gifts, and then capital gifts, which are the gifts to construction, which allows us to avoid debt. So those would be major gifts to major capital projects. But this is a really important funding source of the operating budget. This slide is showing net tuition revenue. So ACO talked about gross financial aid. I talked about gross tuition revenue. This is showing the trend in net tuition revenue. ACO is going to touch more about the financial aid program and its impact on students as well as on the operating budget. But what you can see from this graph is that over time, net tuition, the amount of funding we're getting from the net student charges after financial aid, has decreased by almost 1% on a after inflation basis over this time period. The 2021, a couple of anomalies here. 2021, Williams did not increase tuition during the COVID year, so that's what caused that dip on an inflation adjusted basis, and then it bounced back in 22. These last few years, there have been some enrollment volatility due to post-COVID enrollment trends that are causing some of those spikes, but this is what's happening with net tuition. And now ACO is going to touch a little more on financial aid.
Yeah, so the large reason why you see the kind of decline in net tuition revenue that Mike was just talking about was because of the college's increasing commitment to access and affordability. So this is just a kind of timeline of the college's growing commitment even before the all-grant program. So it included things like free health insurance, covering health insurance for our aided students, and things like the Critical Needs Fund. This is a fund for emergencies that come up. You know, you step on your glasses, you need a new pair of glasses, that kind of thing. And then the all-grant program that I was talking about earlier, that was an additional $6.5 million investment. So if you look at the kind of investment that the college has made since 2018, all in, it's about $10.5 million additional financial aid investment. One important thing to understand about the college's financial model is that even the student who is paying the full sticker price is not covering the full cost of their education. So if you look at the spending per student, it's about $141,000. And the price paid, this is by the full pay student, so a student who's paying the full sticker price, that student is still receiving about $55,000 in a kind of subsidy from the college. And if you look at that for the price paid by the average student, so that's both full pay and aided students, the average subsidy is about $98,000. So then you might say, how do we do this? And this goes back to what we were saying earlier about both the importance of giving and also the endowment. And so this underscores the point that philanthropy and the careful management of the endowment is essential for what we do every year.
So we're going to pivot now to financial capital, a little bit about the balance sheet. And a really important source of financial capital, obviously, is the endowment. So these bars show the total value of the college's endowment over the last 20 years. 2024, it was $3.5 billion. So a couple of quick metrics. One is if you take that $3.5 billion, multiply it by that 5% avail or draw rate that ACO mentioned, you get to $175 million or so, which is how much support the operating budget is getting from the endowment in the fiscal year. We have a smoothing formula that kind of takes into account 3 years of value rather than just spending against 1 year. So that's one thing to mention. The change in the value each year, as you might expect, is due to the gifts that are coming in, the change in market value or investment return, and the draw of $175 million. So that's what's leading to the changes in the height of the towers. The highest year was 2021 when we had a positive 49% investment return. So that's what led to that spike during that year. So a couple of goals of the both investment management and our spending of the endowment that I wanted to touch on. There are 3 main goals of how the endowment is invested. One is to achieve a 5% real return. And that 5% number is not arbitrary. That 5% real return is intended to be the 5% draw that we count on for spending of the endowment every year. Other than the last 3 years where the investment market volatility and pretty high inflation leading into this past year, other than these 3 years where we haven't achieved that 5% return over all longer periods, 5, 10, 15, 20 years, the investment portfolio has achieved that 5% return. So that's great. The second goal is around liquidity, ensuring that we have enough liquidity both to pay the operating bills so that we can count on that $175 million, and so that the investment office can fund the capital calls from our investment partners. And that the portfolio is very well managed to make sure we have that liquidity. The third goal of the investing is around volatility. Because we rely on the investment so much, the endowment so much, there's a lot of risk management that goes into trying to manage volatility of the endowment from year to year through asset allocation and diversification of our asset classes, a really rigorous process for choosing investment partners and managers that is governed by an investment office, investment committee of the board, that are all leading to managing that volatility over each year and over the long term. So those are the investment management goals. On the spend side of things, two main goals that I would kind of share with you. One is to make sure that we're always spending in accordance with donor intent. That is one of our most important fiduciary responsibilities, is that when folks give to the endowment and we're drawing on that endowment, we have a process to make sure that we're spending according to those donor intent. And then the other is protecting the purchasing power of those endowed funds for the long term. So we're counting on that 5% real return over the long term. We're planning to spend 5% over the long term, but making sure that the endowment can grow to protect the inflation-adjusted purchasing power of the endowment so that intergenerationally, the students and faculty of today are benefiting from the endowment that is in place today, as well as the student and faculty of the future. So those are the goals that I would communicate about the endowment, both investing and managing. This slide just gives you a quick snapshot of what the funds that are invested. We have over 1,800 individual funds. We tend to think of the endowment as this one big bucket of $3.5 billion, which that's how it's managed. But from a spend perspective, there are over 1,800 individual funds, many of which have been restricted by donors, and this is what they're restricted to. About 3/4 are to very direct both student co-curricular as well as academic programs and financial aid, and then 1/4 is for more general use of the college for facilities expenses, administrative expenses, and things like that. And then this last slide on the endowment gives you a sense of, on a per student basis, so this is showing Williams against other peers as of the end of 2024. You can see that the top 3 or 4 are much higher than the bottom 3 or 4 or 5. So again, taking that 5% metric, if you multiply the Williams value of $1.7 million per student, that's getting you to around $80,000 per student. So every student on average is benefiting from $80,000 of endowment, regardless of what they pay in tuition, whether they're full pay or no pay. Whereas at Middlebury, they're benefiting from about $20,000 of endowment. So you can imagine the difference in the programs, the difference in the student-faculty ratio, the difference in all kinds of things, the counselors that are on campus that Williams is able to programmatically deliver that some of these schools with lower endowment per student are able to deliver. The other important financial capital is our debt portfolio. And I won't spend a lot of time on this, but if you have questions, I can go into it some more. The date on this is August 27th, and we picked that date because we had just issued the very last series of bonds, Series V. So after Series V of bonds, we had $453 million of debt, all used for facilities over the past. The Series V bonds were borrowed to help pay for the new museum, as well as some improvements in dining and the energy and carbon master plan, and to some extent, some of the dorm renewal, although it will mostly be used for dining and for the energy program, as well as the museum. Sorry, just another couple quick points, Eiko. The overall, for folks who are interested, the overall blended interest rate for the college's portfolio is about 2.7%. That will go up because we just had to refinance the top 2 series that are listed, which were very low interest rate short-term bonds. We have to refinance those on July 1st, at about 3%, so our average rate will go up a bit. It's virtually all fixed or synthetically fixed, and it's virtually all tax-exempt debt. So that's kind of the quick profile of the debt.
All right, so we'll turn now to the strategic priorities of the college. I'm just going to outline these pretty briefly. Two of our highest priorities, one is True Williams, that is kind of what we are calling, what we used to call true affordability. That's our commitment to access and affordability, which we've already talked about. The other is art education, and centrally there, the construction of our new Williams College Museum of Art. I think that this new building, this new home for WICMA really comes out of what has been an evolution over many, many years about the extent to which we teach not only about art, but through art across the whole curriculum. So there's a very, very long history of the museum supporting the teaching of the art history department. But now you will see that there are many academic departments across campus that teach through art. So for example, in the last year, that can include everything from a computer science class on principles of programming languages to bio and organic chemistry to an African dance and percussion class. And just in this last year alone, there are about 220 plus class sessions that were at the museum and more than 3,800 students, student visits to the museum through those class sessions. And so, and I should say that those class sessions actually are not fully meeting the demand for teaching with art. So the new museum will include a whole teaching wing in addition to all of the exhibition spaces that will have more spaces, not just for the kind of teaching that's already happening, but things like more with digital art, space for individual researchers, including student thesis writers, who can have individual objects and artwork pulled from the collection for them to research and so on. So it will really enhance this kind of art education at the college. Also, I've listed some other strategic initiatives here. I'm not going to go through all of them right now. Happy to talk about them in the Q&A some more if you have questions. One thing that I will stress is the importance of faculty research. I had mentioned earlier the uniqueness of our faculty being both active researchers and teachers. And that enhances not just the teaching of the faculty, but also the kinds of experiences that students can have, particularly in the sciences and kind of working in labs with faculty members. So that is very, very important. I would also highlight here under athletics and well-being that we're in the middle of a kind of programming study for athletics facilities, which are in the need of attention, not just from the physical perspective in terms of the state of the buildings, but also in terms of thinking about how our athletics and well-being facilities can support not just our varsity athletics programs, but also the physical and mental health of all of our students, both varsity athletes and those who are not varsity athletes. Also working on various improvements to the student experience when it comes to dining and also residence halls. All right, we'll turn now to the kind of current financial landscape. And I think when thinking about potential financial challenges that are on the horizon, we tend to think about these in two categories. One is kind of those challenges that are a little bit more specific to this moment. They may have enduring effects, but hopefully a little bit more kind of transient. And the second is, I think, what we should think about as a permanent change, and that's the endowment tax. We'll get to that in a second. But in that first category, we're very much attuned to issues of federal funding, especially federal research grants and federal financial aid. Roughly speaking, on a yearly basis, if you were to add up both the federal research funds and the federal financial aid, it's roughly $6 million a year. We're also keeping our eye out on tariffs, tariff uncertainty, and resulting inflation. The kind of estimate for what that would mean for capital projects or building projects going forward is to add roughly 3% or so to the cost of projects going forward. Inflation also puts a lot of pressure on our annual operating budget, which we know from recent experience. The two things that put the most pressure on our financial model, and it's especially hard if they are combined, is inflation and volatile investment returns, which is what we're facing, have been facing in recent years. But in terms of the annual operating budget, inflation means upward pressure on compensation, on those managers' budgets or departmental budgets that I talked about. We are also keeping an eye on what we anticipate may be higher healthcare costs going forward as well. We've also been following possibility of losing our ability to issue tax-exempt debt. Mike was talking about, how we issue tax-exempt debt for our capital projects. This isn't actually an idea that was in the House budget bill that was recently passed, but we're aware of this as well. The rough estimate is that if we lost our eligibility to issue tax-exempt debt, it'd increase our interest rates by about 1.25% or so. Also following changes to the Inflation Reduction Act, and what that might mean for tax credits, particularly for our energy transition and a transition to geothermal energy in particular. We haven't been budgeting, we haven't been assuming the tax credits when we've been estimating the cost of these projects, nonetheless keeping an eye out on that.
Okay, we're going to talk a bit now about the endowment tax, and then I'm sure there may be some questions as we get to the Q&A. Williams has been subject to what is fondly called the endowment tax since 2019. It was passed during President Trump's first term in 2017 as part of the Tax Cuts and Jobs Act, but we first became subject to it in 2019. The college has paid in the range of $2 to $2.2 million on average over those years. And importantly, it's a tax on net investment income. It's not a tax on the value of the endowment. It's not a tax on the change in unrealized gains of the endowment. It's a tax on investment income, interest and dividends, and realized gains that are realized through all of our partnerships as well as our individual investments. So that's kind of the background. The most recent bill that has been proposed by the House, and we've been subject to it. I also should mention that the eligibility for the tax in the past is if you had an endowment per student of $500,000 or more, you were subject to the 1.4% tax. And Williams was one of about 56 schools that were subject over these past 5 years. The House's most recent proposal in May was to have 4 tiers that would increase that 1.4% to 7%, 14%, or 21%. At this point, we believe if the current proposal were to proceed through the Senate and through the reconciliation and to the President, that the college would either in the first year or pretty soon thereafter be subject to the 21% tax. And what the box at the bottom here is just giving you an indication of, for each of those increased tax levels, what the impact would be on the operating budget. So for example, I'll use the 14% because it's just easier numbers, but if the 14% tax comes into play, then that would be a $30 million impact on the college's budget in the first year. And as perspective, that's almost 10% of the current year budget, and it's about 30% of our financial aid budget. So this is not insignificant to Williams by any stretch, and it would require long-term changes in the budget over time. So what are we doing about this? Eiko is going to talk a little bit more about the principles that we think of as we're thinking about the long-term strategies. We're very actively, as you can tell, paying attention to this, following it both on the finance side, the government affairs. We're part of some coalitions of other colleges that are trying to influence the legislation, both in the House, which didn't make much progress, in the Senate, which we're hopeful for, and then in the reconciliation. The investment office is looking at what other opportunities there might be to moderate the impact on an after-tax basis of this format. And then we're also very much thinking about what are the types of things we would pursue in the future for the operating budget, which Eiko will touch on a little bit. Do you want to touch on that, or do you want me to touch on it?
Why don't we see what the questions are and we can come back to it? Yeah.
Okay.
All right, so Mike mentioned the kind of principles that that guide our annual budget process, but they're also especially important perhaps in financially difficult times. So just to start with the kind of top one there, which is really the key one, which is prioritizing what's most central to the college's educational mission of teaching and research. That is always foremost in our minds. We're also seeking to ensure the financial health and sustainability of the college in the long term. So we're always thinking about the long-term consequences of any decisions made in the present, what unintended consequences there might be. We also focus on what the college does especially well and with the highest impact. And we're also seeking to maintain our stated commitments, including competitive compensation for our faculty and staff. This last bullet is something that we have been saying regularly for the past couple of years, which has to do with how we fund our strategic initiatives. And one of the assumptions there is the understanding that the endowment funds are current commitments only. We can't continue to put more and more pressure on the endowment. So that means if we want to do new things, there either has to be a reallocation of revenues or there has to be a new source of revenue. And that is why, to the last bullet there, the importance of philanthropy, of encouraging and supporting philanthropy, is especially important.
So just to echo what Aiko said, this is absolutely a national piece. At Williams, the high water mark was 62% participation across the alumni body as a whole, and that was in 2012. Individual classes certainly have had higher participation than that. You see it very often among our post-50th classes. It's not unheard of for classes that are post-50th to have 100% participation, for example. Across the board, we have an 85% lifetime donor rate, so among all alumni who continue to associate with Williams, which includes folks who came to Williams but actually transferred out and graduated elsewhere. 85% of the total have given to Williams in their lifetime. This year, Sheila, we're just over 41% currently, and there's still another 3 weeks to go in the fiscal year, so we'll continue with those efforts. When it comes to building the pipeline, we very much value participation. We really have and have had since the Great Defection of 1821, and the way in which the Society of Alumni was founded, really been all about collectivism and what we can do together as a community. And so we do really pride ourselves on participation. We're one of, I think we were the only one of we were one of 2 schools among our peer schools to stay above 40% participation last year. And really what we've seen is that colleges that had high participation nationwide are those that have, at this point, greater than 20% participation is considered high participation nationwide. Nationally, it's gone from, I believe it was in 1975, the average was 20%, and now it's less than 5%. But among schools where there's high participation, it's still 40% is really now sort of where 60% was, is this sort of gold standard of participation. When it comes to building a pipeline and helping to ensure the future financial solid footing of the college, again, we value participation because every little bit really matters. And also we recognize that there are significant abilities for some folks to be able to contribute based on the fields that they choose, the wealth they may have inherited, and that sort of thing. We see about 7% of our donors each year make leadership gifts to the Alumni Fund, which are gifts of $2,500 or more. And together, those gifts total about 70% of the total raised.
All right, well, thanks very much for coming and for your really good questions. We'll stick around afterwards if there are other things that you want to talk about. And I hope you enjoy the rest of the weekend.
Thanks, everyone.